Candlestick charts are more than just a tool, they are a psychological battlefield. In the world of cryptocurrency, where volatility is the norm and emotions run high, candlestick patterns reflect the collective mindset of traders. Every wick and body on the chart reveals a story of fear, greed, hesitation, or conviction. Mastering candlestick psychology means learning to interpret these visual cues to anticipate market movements. Whether you're a day trader, swing trader, or long-term investor, understanding the emotional undercurrents behind price action can offer a distinct edge. In this video, we'll explore 10 critical tips to help you decode candlestick psychology and make smarter, more confident decisions in the crypto markets. 1. Understand the battle between buyers and sellers. Every candlestick represents a war between buyers, bulls, and sellers, bears, within a specific timeframe. A green candle with a small upper wick suggests strong bullish control, while a red candle with a long lower wick might indicate sellers initially dominated, but buyers pushed back. Recognizing who won the battle, and how fiercely, can help predict the next move. Candles are not just data points, they are emotional snapshots of supply and demand in real time. 2. Focus on the size and position of wicks. Wicks, or shadows, represent rejection. A long upper wick on a green candle suggests buyers pushed the price up but couldn't hold it, indicating resistance. Conversely, a long lower wick on a red candle implies buyers stepped in after heavy selling, showing support. Analyzing wick size and position can provide insight into market sentiment, revealing hidden support, resistance levels, and giving clues about upcoming reversals. 3. Learn key reversal candlestick patterns. Patterns like the hammer, shooting star, engulfing, and doji are not just technical formations, they represent psychological shifts. A bullish engulfing pattern means buyers have overwhelmed sellers after a downtrend, often signaling reversal. A doji, where open and close are nearly equal, indicates indecision and tension. Understanding these patterns helps you visualize trader hesitation, exhaustion, or renewed strength. Always assess these signals within the larger context of market structure. 4. Analyze candles in context, not in isolation. One of the biggest mistakes beginners make is reading single candlesticks without considering the surrounding market context. A doji in a strong uptrend doesn't necessarily mean reversal, it may simply reflect temporary consolidation. Always look at multiple candles together to detect patterns or themes. The story unfolds through sequences, not snapshots. Analyze the trend direction, volume, and support, resistance zones to interpret candles accurately. 5. Recognize emotional traps like fakeouts. Candlestick psychology is full of traps, especially in crypto, where price manipulation is common. For example, a candle might break above resistance with a strong green body, luring traders in, only to reverse sharply on the next candle, a fakeout. Recognizing these traps requires experience and understanding of market psychology. Fakeouts often occur during periods of low liquidity or right before major news. Wait for confirmation on higher timeframes before committing capital. 6. Use volume to validate candlestick sentiment. Volume is the fuel behind candlestick moves. A large bullish candle with high volume confirms strong buying interest, whereas the same candle on low volume may reflect a temporary price pump with little conviction. Volume helps distinguish between real momentum and weak attempts to push price. When volume aligns with the candle's message, the psychological signal is stronger and more reliable. 7. Timeframe matters. Zoom out to gain perspective. A candlestick on a 5-minute chart can look entirely different from one on the daily chart. Short timeframes exaggerate emotions and noise, while longer ones reveal dominant trends. Traders often misinterpret candles because they don't consider their timeframe's limitations. For better psychological insight, always zoom out to higher timeframes, 1H, 4H, daily, and align your analysis. This reduces the influence of false signals and helps you understand the broader market sentiment. 8. Observe candle closes, not just intrabar movement. The open and close of a candle tell you where sentiment ended up, not just where it went. A candle may swing wildly during its formation, but its final close determines whether bulls or bears had the final word. For example, a candle that was deeply red during the session but closes green with a long wick reflects a major sentiment shift. Watching how candles close, especially around key levels, reveals the true market psychology and strength of conviction. 9. Anticipate common emotional reactions near support and resistance. Support and resistance levels are psychological battlegrounds. Candlesticks that form near these levels often carry the weight of mass trader expectations. A bullish engulfing candle off support might trigger widespread buying due to confirmation bias. Similarly, a bearish reversal candle near resistance may cause panic selling. Learn to recognize these setups and understand the emotional narratives that drive crowd behavior, such as FOMO, fear of missing out, or FUD, fear, uncertainty, doubt. 10. Practice patience. Let candlestick psychology play out. Successful traders don't chase candles. They wait for patterns to complete and for market psychology to unfold. Jumping in too early, especially during volatile swings, often leads to poor entries. Mastering candlestick psychology requires discipline, patience, and the ability to detach emotionally. Let the market tell its story through candle sequences, and wait for high-probability signals that align with broader trends and confluence zones before entering trades. Mastering candlestick psychology in crypto trading is about more than memorizing patterns. It's about interpreting human behavior encoded in price action. Each candlestick tells a story of emotional highs and lows, fear and greed, struggle and surrender. By learning to read these stories, traders gain an invaluable edge in anticipating market movements and avoiding costly mistakes. From analyzing wicks and patterns to understanding the role of volume and market context, the journey to candlestick mastery is a blend of art and discipline. As crypto markets continue to evolve, those who can decode their psychological rhythms will remain one step ahead. Develop this skill with practice, study, and a calm mindset, and you'll be better equipped to navigate the chaos of crypto with clarity and confidence.